Hello, I'm Scarlet Fu. Welcome to Bloomberg Front Row. Today, I'm talking to Franklin Templeton President and CEO Jenny Johnson. She just became the fourth member of her family to lead the investment firm her grandfather founded more than 70 years ago. But she's taking the reins at a turbulent time for the asset management industry. Jenny believes the finance world needs to change its image and accentuate the positive.
I think we're often, by the media, thrown in as just, you guys are a bunch of greedy Wall Street people. The reality is, I can tell you the colleagues that I work with, my peers in the industry, really try to focus on what's doing right for clients.
We discussed Franklin Templeton's $4.5 billion purchase of Legg Mason, the future of asset management, her firm's strategy in a time of competition and consolidation, and diversity as a leading woman in a male-dominated field.
I was asked by an employee at one point, well, what do you do when you walk in a room and you know that all the men are thinking that you're not capable or, competent? And I said, boy, I've never walked in the room and thought that. And by the way, never let that be in your head.
Here's my conversation with Jenny Johnson. I want to start on the Legg Mason purchase. Franklin Templeton announced Legg Mason purchase in February, right before COVID hit and sent markets reeling. You closed the deal ahead of schedule. How has your thinking on the necessity of this deal evolved as market conditions have changed?
Yeah, it's interesting because when it happened, of course, as you mentioned, the market tanked with COVID coming on, and we never lost sight of the fact this was a growth story for us. We're long-term in how we think about the business. For us, it was about an all-weather product lineup, filling in product gaps that we had. Really diversifying our client base. We're now 50-50 retail institutional, and frankly, greater scale in really important markets like Japan, Australia, and the UK. And so, we tend to run this business over the long term. That minor kind of setback, we still felt like it was absolutely the right thing to do.
But if you were to look back in a perfect world, is there any part of the deal that you wish you could redo, maybe?
No.
All good, even the price, given how much markets have fallen since then?
Well, markets are coming back up. And so, again, the hard part about asset management is rarely do people sell when markets go down. So, the alternative was maybe that deal wouldn't have been available to us. You can't control the markets, but we can control our strategy. We can control again, the key to having really an all-weather product lineup. So regardless of where the market is and where the economy is, there's something that's appropriate for clients.
Now, when it comes to the integration of the two firms, is there anything that might change when it comes to your plans because of the new normal that we're living in?
So what made the Legg Mason deal work for us is we've always, as you know, we've done large asset management deals in the past with Templeton Mutual Series, high net worth business, fiduciary trusts, and frankly, a lot of them across the globe, and most recently, Benefit Street Partners. What we understand is that we are buying an investment team and an investment process. So we have always left those as independent, sitting on a very powerful base of technology, risk management. And we think the world going forward, that things like data analytics can be more and more important. So the ability to bring that in and spread it over a bigger base is better. Well, Legg Mason was structured exactly with that, with its what they called affiliates, so the individual investment teams reporting into a holding company. And so our complete focus on integration has been at the holding company level. You only need one holding company, and combining distribution, because obviously you need just one team servicing your clients. And so bringing those together it was different in that we had to do this assessment via video. That wasn't what we were planning on doing, but we closed 30 days early. So I think it worked out pretty well.
Franklin Templeton now has $1.4 trillion in AUM, reversing years of falling AUM. What's the significance of being in the $1 trillion club?
Well, I think what is key is our business. There's a lot of pressures on the business. And I think one really important component of active management is going to be this need to get massive amount of data and to get data insights from non-traditional sources. The deeper your data lake and the wider your data lake, the breadth of your data lake is going to be able to give you greater insights. And so we think being able to spread that type of initiative across a broader client base is better.
Let's talk about active management, because now, if any, is the time for active to shine. If you can't do it now in this period of upheaval and volatility, the perception that your company or the industry at large is in deep trouble, is in some kind of long-term secular decline, becomes that much harder to shake. Can you talk a little bit about the pressure to get this right now for Franklin Templeton and for the industry overall?
Well, first of all, passive tends to do very well in momentum markets, right? It's a market cap weighted. And I want to talk about this from an equity standpoint and then a fixed income standpoint. So from an equity standpoint, you have 6 stocks in the S&P 500 that has basically generated 10 times the return of the rest of the S&P 500, right? So if you were an active manager and you underweighted any one of those 6, it probably didn't matter that you got the sector bets or the individual stock bets in the other sectors right, because there was such a barbell as far as returns. I don't think that carries forward at the same level. And so, we look at it just today. I was having a conversation with our biotech team, and we have PhD scientists on our biotech team. And you think about all the companies that right now are talking about the vaccines that they're now developing and how that's impacting their market cap. Well, what the biotech team's comment to me was, Jenny, good science is what translates into good returns. You have to understand the approach on these. That's fundamental analysis. That's having people who are so steeped in individual sectors and understanding behind them that they can make those picks. I think that becomes very important going forward. And then I just say on the fixed income side, look, the fact, if you just think conceptually that passive fixed income is about when companies take on more debt, you're increasing your exposure. That just doesn't make sense, right? I mean, it's a dangerous way to have an investment strategy. I know our Muni group, and talking to them when COVID hit, and they had the benefit of understanding already the credit worthiness of various states and municipalities. And then they could pivot when they looked at it and said, wow, this is going to impact certain sectors are very vulnerable to this, healthcare, transportation, and other sectors are immune. So they can pivot their investment strategy to take advantage of those moments very quickly because they have that deep understanding.
You've got better technology, you've got systematic strategies, all of which have shown that humans are not very good necessarily at consistently picking winning securities over the longer term. I mean, that's just kind of what the numbers bear out. So over the longer term, does technology win out?
The data is going to be very, very important. But here's what data doesn't tell you. When something externally changes, the Fed changes their policy, the ECB changes their policy, there's some regulation that comes in, you have to have the combination of both people and data. And that's where I think active management is evolving, where you're bringing those two things together.
Do you think we'll see the move from active to passive slow or stop in the next couple of years?
The big question that I think, you're seeing is with the percentage of passive, does that become kind of this self-fulfilling prophecy? It's fast on the way up, and we saw it in those couple of months. On the way down, it's even faster, right? There's no buy bid on the passive model on the way down. Active's going to shine as the next decade's going to look very different from the last. I mean, there's a lot of sensitivities that companies are going to have to be able to maneuver, including supply chains. And so being able to fundamentally get under the covers and understand the impact of these types of decisions is going to be important. And then, of course, ESG, I think, is an area that you benefit from active management.
When you look at your rivals in the fund management industry, it's clear that some were positioned pretty well for some pretty big shifts. BlackRock, for instance, with the rise of passive and ETFs that target specific sectors or markets, Eaton Vance with tax-efficient products. What do you think is the next big shift in the industry and therefore for Franklin Templeton to capitalize on?
So I think customization is going to be very important. And I think that people often discuss ETFs as being synonymous with passive, and it's not really that. An ETF is just a vehicle to deliver capabilities. It has different characteristics than other vehicles like SMAs or CITs, collective investment trusts. And so what we view as Franklin Templeton, we have investment capabilities across the full spectrum. We will deliver them in whatever way in which our clients want them delivered, in whatever vehicle, including really customized separate accounts. And that's where technology is enabling you at a much smaller account size to deliver more customization. So I think that we're going to see more of that.
So that leads me to my next question. The 60/40 portfolio is kind of the bedrock of the modern asset management industry, but we know that the relationship between asset classes has changed quite a bit. People buy stocks for dividend payouts, for income. People buy bonds to participate in price rallies, and interest rates are lower for longer. Is 60/40 dead?
I think 60/40 is a blunt instrument, and we have more tools to fine tune the management. Now, you also had an issue with the 60/40 in that a lot of institutions had, say, a 7% target, and their fixed income was yielding such low returns that they found themselves having to move further on the risk curve. And so you saw them go into alternatives. So I think that the real answer is it's not that 60/40 was bad. It's just that we have better tools to fine tune for folks' individual goals. And you're going to see more of that customization.
When we look at what's going on, there's a ton of liquidity floating around. There's an everything rally where risky assets and safe havens are both rising. What do you think success in the asset management industry hinges on most in that kind of environment? Is it alpha generation? Is it leveraging scale? Or is it something else?
So I think the key for the asset management is what value are you bringing to your client, right? And so really understanding what your client's needs. If it's a pension fund, it's a series of cash flows, liability-driven investment. They need portfolios that are structured for that. I think what's happening on the retail channel is because the world's gone to fee-based, clients are looking at their financial advisor and saying, you know what, it's not enough that you just give me an investment portfolio. I want you to help me do financial planning. I want you to have a tax efficiency in this. I may even want you to educate my children on how to be financially savvy. And so as those additional demands are coming on us from our clients, it's about meeting those needs and really showing value for what you're paid.
And meeting clients' needs also means expanding your product offerings. You have a venture fund, you have private equity, you have private credit. How are you building up these different areas? Are you doing it through acquisitions, or are you building it up on your own internally?
So it depends. We were fortunate to get Clarion, a really phenomenal real estate manager with the Legg Mason acquisition. In general, private assets are a little bit difficult to buy because the people selling them, I say, they always have more information than you do. And so, we have taken the approach that at times, and we'll buy it. We bought Benefit Street Partners, and that was private credit. In the case of private equity and venture, we've started to organically grow our own. We're headquartered in the heart of Silicon Valley, so we, I like to say we have social events. We used to pre-COVID with a lot of these entrepreneurs as well as venture capitalists, and so it gave us kind of a front row seat to that. So that approach was more of an organic approach.
How much more consolidation do you think we'll get in the asset management industry? Are we in the second inning, the fourth inning?
So there's certainly been predicting for the last probably at least 5, maybe even 10 years, there was going to be this massive amount of consolidation. And you started to see it. There's been some big deals. I think that the pressure on the industry on fees is going to have a push towards consolidation. I think the investments required in things like data science, and when I talk about data science, it's investments in AI, investments in natural language processing, all those supporting the investment teams. I haven't even talked about the investments on the fintech side for distribution. I mean, there's massive amount of investments that have to happen there. One of the key drivers on our Legg Mason deal is we knew we had to have cash on our balance sheet. It was very important to us. Post-deal, we have $5 billion in cash and investments, precisely because we want to have the flexibility to continue to make these investments. That's hard to do when you're small.
Franklin Templeton is known for Mark Mobius, who left the firm in 2018, for its emerging market prowess. Obviously, things have changed and you've grown through acquisitions. What do you think is the Franklin Templeton brand now? What do you want it to be known for?
We want it to be known for helping people solve the most difficult problems that they have in their life. And I think that I think actually as an industry, we got to do a better job talking about what we do. I think we're often by the media thrown in as just, you guys are a bunch of greedy Wall Street people. The reality is I can tell you the colleagues that I work with, my peers in the industry really try to focus on what's doing right for clients. And if you think about, you think about as we're having an aging population, as people are moving into retirement, are they saving enough? Have we helped them save enough? Do they have the appropriate strategies as they're living longer to ensure that they can stretch out what they've saved? If you know somebody who has a special needs child, one of the great fears is, will there be enough money once I'm gone to ensure that this child is taken care of? Those are the things that are real. And then you just think about what's happening today with vaccine development. These are public companies who are out there who are using the dollars of our shareholders, right? The investors and the profits and trying to develop really important needs for society. So to us, Franklin Templeton is a part of this. We are helping people solve the most important goals in their life.
The business of asset management is really based on the idea that humans can beat the markets in a meaningful way over a long period of time consistently. Some would call that an anachronism. It's certainly a goal. I think about the people who do that job, star fund managers. We don't hear about them anymore. Why don't we have them anymore? Why doesn't the industry promote them anymore? The interesting thing with the star fund manager is that the reality is they were always supported by a large team. I think maybe it was easier for people to connect and maybe from a marketing standpoint, we'd say, oh, it's, X person who's really behind this. But the reality is it was always a team. And so that's one. And then number two, clients get nervous by star managers, if you point one, because then it becomes a succession issue. They want to know that you can seamlessly are developing the team behind, just as any CEO is expected to be developing the team behind them. Yeah, but star fund managers help differentiate different firms. Mark Mobius was always tied to Franklin Templeton. If you don't have someone recognizable, people can turn to price as their primary driver, and then it's that much easier for them to go to a passive product or to an ETF.
You're going to have to show value. We've talked about that. There's no question you're going to have to show value. And I think people like to understand the strength of the team versus a single individual making all the decisions, that they recognize that that's just not credible with all the information you have to gather, the deep understanding that you have to have in individual sectors and analysts, that it's just not credible to say one person can do all those things.
When we talk about fund managers, at least in this country, it tends to be he or him. Why have we not had any female star fund managers? And do you see that changing?
Well, it is something that we're very focused on. And we've had as high as, I think, 27%. As we've done acquisitions, that's diluted our number a little bit. But I think we were always a firm that had a lot of strong women as managers. I think that the industry is learning, we are involved in something, Girls Who Invest, get girls interested earlier in this business. But part of that's also, my daughter said to me, Mom, I don't really want to go into your type of business. I want to help people. And I'm like, this business helps people. And so if we can articulate it in that way and get to girls earlier, I think that you're going to find more are attracted to it.
If attracting and retaining women is as important as we claim it is, how directly tied is that to how you're thinking about remote work plans?
As a mother of 5 and as the daughter of a mom who had 7 children and then graduated from Stanford Medical School, I think that moms have to figure out how to blend work and home life really, really well, which means we need a little bit more flexibility. And so I think that this whole work life, one is you take out the commute, 2, you can get up and take care of whatever you need to get up and take care of. So I think in many ways it will play to the strength of women. I also think that men have been a little bit disadvantaged. And I know a lot of men that would love to coach their kids, sports teams, and yet they weren't sure that was okay in the office. And so I think this environment's actually going to allow both parties to do more of this integration between home and work. And I think that's better for everybody.
Do you think the male leaders in finance and other industries see this crisis the same way you do?
So it's been very interesting listening to other CEOs' views about whether this new work is permanent, or are we going to absolutely go back to where we've been? And we have our own question around, sort of what does the office look like? I think the reality is you've got a top performing employee who commutes 3 hours a day, 90 minutes each way, not an unusual commute in, say, New York City. And they're just realize they can do a lot of their job from home. I think we're going to all have to learn to figure out how to accommodate and leverage technology to create those kind of collaboration opportunities. So I don't know quite what the world's going to look like. I mean, it is a debate we have, but I think it's going to look different.
Jenny, you are the fourth member of your family to serve as CEO, Franklin Templeton, to lead the firm. How do you reconcile that and your efforts to promote diversity at the firm with the fact that this is ultimately a family-run business?
Well, so first of all, we're a public company, and while the family has a significant interest in it, we're minority shareholders. We don't own a majority of it. So we have to run it every day as a public company and think about what's right for the long run. I'd say the one difference is that when you have still founders having concentrated ownership, they're really able to think more long-term as far as investments that they make. One of the risks today of public companies is CEOs have so much pressure for quarterly returns that sometimes there's a question about whether they're really making the best long-term decisions for the business. And I can tell you, we operate this company thinking in the long term for the business.
I want to talk a little bit about what happened with the Amy Cooper situation 3 months after that unfortunate incident. I wonder what has changed at your firm. How do you monitor employees' behavior and stay on top of what they say and what they do?
So, part of it is you have to, from the very top of the firm, behave in a certain way and just show zero tolerance for any kind of racism or discrimination. At my core, I fundamentally believe, and I believe their executive committee fundamentally believes, that a diverse workforce is better for us, better at decision making because you're going to get more views, better because it reflects our diverse client base. And so it's about, for us, continuing to always rethinking how can we ensure greater diversity and inclusion. And as we hired prior to the incident in Central Park, the chief diversity and inclusion officer at Legg Mason, and Regina Kerr is reporting directly to me as the CEO. That's how important D&I is to Franklin Templeton.
D&I is clearly something that you're very passionate about, and I can hear it in your voice. I can see it in the way you're talking about it. How do you think your lived experience heightens your perception of what's happening on the diversity front?
In some ways, I always feel a little bit, obviously I'm a woman CEO, but I, grew up in a household where my father celebrated strong women. I mean, my mother I think she was one of 10 women graduating from Stanford Medical School. And so, I've always grown up in this environment where there's just somebody who believed in me. And I think that makes a big difference. I was asked by an employee at one point, well, what do you do when you walk in a room and you know that all the men are thinking that you're not capable or, competent? And I said, boy, I've never walked in the room and thought that. And by the way, never let that be in your head, right? Why use up any of your mind share to think those things? So I think I'm very fortunate, but you got to talk to people, you got to listen to people, and so that you can understand what their experiences are.
That wraps up my front row conversation with Franklin Templeton President and CEO Jenny Johnson. Stay tuned to Bloomberg Television and Radio for more exclusive interviews with leaders in business and finance. And be sure to visit Bloomberg.com for all the latest news and analysis 24 hours a day. Stay safe, everyone. I'm Scarlet Fu. This is Bloomberg.